which will end up giving us what figure, ladies and gentlemen? 1.1 raised to negative 1. Please give me a figure. 1.1 raised to negative 1. Please give me a figure. Please give me a figure. 0.9091, isn't it? Now come and give us the next PV figure. Give us the next present value interest factor figure. The next present value interest factor figure. Is there somebody who is talking about 0.8 something? Thank you very much. Trust you me, whatever answer you have given me is very far away from the truth. The truth is there, and your answer is on the other side. And in between here, we have got 100 kilometers. Why? Still, we are talking about end of year what? 1. We haven't gone to year 2. This is the end of year 1. And if it's the end of year 1, ladies and gentlemen, the PV should be the same. 0.9090 what year? 91. Why do you make use of 2? And the 8 you can see this is 1. This is 1. Sorry for that. Sorry for that. So please, if now we are to get up to there, the next thing will be for you to come and give us what we call the PV. What we call the PV, my cameraman. What we call the present value. Present value. Present value. What are we doing to get the present value? We are taking the cash flows multiplied by the PV. The cash flows multiplied by the PV. 2 decimal places for the present value. 2 decimal places for the present value. So the first one, 2 decimal places over here, what do we have here? Somebody? 25,000 negative. How about the second one? Will be minus this times that. 2 decimal places. Who is able to give us that answer very fast? 68, 18.25, and it's a negative figure, isn't it? 2 decimal places. Remember, it is only PVs or PVFARs where you have to be very concerned with the decimal places, and we always have to go to 4. For PV and the PVFAR, you must always go up to 4 decimal places. So there we are. We've been able to get the present value for this. How about this other figure? Take 15,000 times 0.909 over n, 2 decimal places. What figure do we have there? 1363. 63 point? 6.50, like that. Hope these figures are correct. And remember, this one is a resale value, so it's a cash inflow. So I should be talking about a positive figure. Once I reach, ladies and gentlemen, come and give us what we call the net present value. What we call the net present value. The net present value. Give us the net present. Who is able to see the net present value? You add them, because now they're children of the same mother. Because now they have been present value. They have been discounted from the future to today. Now they are compatible for purposes of addition. Remember, in finance, a shilling today is not exactly equal to a shilling tomorrow. In between here, there is a lot of corrosion of value. I'm being given a figure of negative 18. 181.75. Double underline that figure. Double underline that figure. Double underline that figure. Double underline that figure. Now, ladies and gentlemen, if you allow me, I'll now look for the PVs of year 2, 2-year cycle. 2-year cycle. Come and write a column there of PV at still 10%. PV at 10%. PV at 10%. At times, these little snippets that I normally give you about examiners make me look bad. There are times students have told me, Mwalimu, you are a sadist. No, trust you me. I'm among those people who wish their students here the very best. Why at times I give you those small snippets is to enable you understand, in this case here, how a bad examiner can twist the question. Can twist the question. The others who told me, Mwalimu, will talk to CASNEV, never to allow you to test us. But I'm not even an examiner with CASNEV. I'm not. So don't waste your time going to that place. Very good. So come here. The PV for time 0, what do we have? 1. Time 1, I'm copying these figures. Time 1, we have 0.909 rate. Time 2. Time 2 now I have to talk of 1.1 raised to minus 2. 1.1 raised to minus 2. What figure do we have there? Time 2. What do we have here, ladies and gentlemen? 1.1 raised to negative 2. I'm being given a figure of 0.8264. Ladies and gentlemen, please look at this. This is still time 2. This is still time 2. So time 2, you simply carry the time 2 figure that you had up there. So you should talk of 0.8264. So come and give us the last column there for present value. Give us the last column there for present value. Give us the last column there for present value. You are taking the cash flow multiplied by the PV. The cash flow multiplied by the PV. Cash flow multiplied by the PV. What do we have here? We have to multiply. What figures do we have here? The first one is minus 25,000. The second one will be minus 7,500 times 0.991, which will be 18.25 negative. Go to the second, this 11,000 times that. Please give us a figure. This will be negative something. This will be negative something. What do we have there, somebody? So minus 11,000 times this figure. What are we able to see, ladies and gentlemen? Negative 90.4. Thank you very much. From there, we go to this other resale value, which is 10,000 multiplied by this. 10,000 multiplied by this will be 8,264. Now come and add. I hope my cameraman can still see me all the way up to here. So we have what we call net present value. Net present value. Negative 32,644. Thank you very much. Negative 32.65. Now, could you kindly, great students of mine, do me a favor? Kindly do me a favor by extending the same skill that I've just shown you for a 2 years cycle, 1 year cycle, to 3 year cycle. Could you kindly provide a working for us for a 3 years cycle? A 3 year cycle, I'm giving you exactly 2 minutes. have they been able to finish these NPVs of NPV for year 3 negative, even year 4 they have finished years? It's better to replace end of year 3. Don't decide that first. So they're telling me, Mwalimu, do a summary. Do a summary. Do a summary. Thank you very much. The summary is here. The summary is here. We have what we call net present values. And then we have years. So we have year 0, or rather year 1, year 2, year 3, year 4. So if we replace at the end of year 1, our NPV will be negative 18, 181.75. If we replace at the end of year 2, it will be minus 32. Minus 32, 644.65. If we replace at the end of year 3, what are they saying there? If we replace at the end of year 3, what are they saying there? Someone check for me. End of year 3, what will be the resultant NPV? Negative 44,665. 5.15. Can somebody confirm whether NPV of replacing at the end of year 3 is correct? Is this correct? Yes. Thank you very much. How about NPV if we were to replace at the end of year 4? At the end of year 4. Negative 58. 837.40. Now, ladies and gentlemen, please don't make your decision on the basis of net present values, because you can see that our replacements are not of equal lives. Our replacements, ladies and gentlemen, that we have here are coming with different lifespans. So we need to standardize them. We need to find an average. And for us to standardize, get an average in the usual financial management way, we shall get what we call an annuity equivalent value. So come and give us annuity equivalent values. Annuity equivalent values. What we call AEVs. Annuity equivalent value. The question that I have for you, or rather I can even go ahead and answer this question. Ladies and gentlemen, for us to get our annuity equivalent value, we normally take net present value. We normally take the net present value, divide this by the famous PV factor. You divide this by the famous PV factor. So the annuity equivalent value. How do we get annuity equivalent value? We'll take the NPV divided by PV factor, like that. It's a formula that you must cram. So meaning, ladies and gentlemen, that we need to come and create a column up here, first of all, of getting the PV factor. And of course, as such, we must be at a position of remembering the PV factor formula. So come and remind us, ladies and gentlemen, I'm so sure so many students will not be able to remember the PV formula. PV formula, it's very easy. To get the PV formula, ladies and gentlemen, we normally take 1 minus the simpler formula, which is 1 plus R, raised to negative what here? N. Raised to negative N. And then everything, ladies and gentlemen, everything will be divided by R. Everything to be divided by R. So we start with the first category here. The first category, remember our R is 10%. So when our R is 10%, what will we talk about? In the first arrangement where N is 1, we'll talk of 1 minus 1.1 raised to negative 1. And then everything here to be divided by what here? R, which is 10%. Of course, for 10%, it will be nice for me to get the figures from my table. But I know the current exam, and I can tell you without, in this case here, or rather, I can tell you this with a lot of certainty. Nowadays, the examiner will give you rates that you need to remember the formula. So can somebody punch this? When you punch this in your calculator, you will say 1 minus 1.1 raised to minus 1, everything to be divided by 0.1, which gives us 0.9091. How about the second scenario when n is 2? When n is 2, ladies and gentlemen, I'll talk of 1 minus again 1.1. Where am I getting this 1.1 from? Because of r. 1 plus r raised to negative n, so raised to negative 2, divided by our constant r, which is 0.1. So what do we have here? We have 1 minus 1.1. We have 1 minus 1.1 raised to negative 2 equals divided by 0.1, divided by 0.1, which will end up giving me 1.7, like that. So for negative 3, I have 1 minus 1.1 raised to negative 3 equals divided by 0.1, which will end up giving me 2.4869. 2.4869. And then lastly, we have for year 4, ladies and gentlemen, I'll talk of 1 minus 1.1, 1 minus 1.1 raised to negative 3 equals divided by 0.1. I'm able to get 2 point what here? 2.4867 like that. So those are the PV files that we have. Once I have my present value interest factor of an annuity, don't forget the road to Damascus. What we wanted to get at the end of the day, our objective was to get the annuity equivalent value, the standardized NPV. And how do we standardize this? We normally take the net present value divided by PV. I hope my cameraman is able to see me all the way up to here.
I think that's yours for year 4.
Mine for year 4, they are telling me, Mwalimu, yours for year 4 is wrong. Let's repeat. Let's repeat. You know, you guys, you are young with a bright future. So we have here for year 4, so 1 minus 1.1 raised to negative 4 equals divided by, yes, I'm wrong. I'm wrong. It's supposed to be 3 point. Thank you very much. 3.1699. Thank you very much. And then I'll go ahead and standardize as per that formula. Take this column, you divide by the PV for figures. So the first one, I will talk over minus 18. 181.75 divided by 0.9091, which gives us negative 999.73, 2 decimal places. Come and take the next one. The next one is minus 32. 644.65. Divide this by 1.7355, which will end up giving us minus 18. Minus 18, 809.94, 2 decimal places. 2 decimal places. From there we have here minus 44, 665.15 divided by 2.4869, which will end up giving us minus 17, 960.17. And then we have the last one, which will be minus 58, 837.4 divided by 3.1699, which will end up giving us minus 18, 561.28 like that. So these are the annuity equivalent values. Those values that you have ascertained, which now assume like all the replacement cycles are of the same period, same period. Now with these annuity equivalent values, the way I'm able to see them, it's like all of them are what here? Losses. And therefore, because I have to go with one cycle, I'll go with that cycle, which will minimize my loss. So this one here, I'll be losing 19,000, I'll be losing 18,000 or something, I'll be losing 17, I'll be losing 18. So then at the end of the day, I'm better off losing 17 than losing more. So in short, this is the optimal value, optimal annuity value, the optimal annuity value. Having known that that is the optimal annuity value, therefore, the optimal replacement cycle is a 3-year cycle. Is a 3 years cycle. So replace at the end of year 3. Every time you buy, stay with it for 3 years, sell like that. Very good. Now, ladies and gentlemen, if you allow me, is there anybody who has a question? Is there anybody who has a question? Is there anybody who has a question? I told you that this was simply a simple question for CPA section 3. This now is the question that we should be getting in section 5. May 2015, question number 1, boy. May 2015, question number 1, boy. We could search it for them again. May 2015, you have to get from the revision kit. May 2015, question number 1, boy. May 2015, question number 1, boy. Just move quite fast and get it. May 2015, question number 1, boy. For those students who are following us online, today we have been very good to you. We have given you a whole hour free of charge. So what you do, because you are disconnecting immediately, if you are interested in getting access to our online lectures that will cost you just 100 bob for a 2-hour lecture, 100 bob for a 2-hour lecture, simply call us. Call us at this number, 0719 525,000. This is RCM Online College. Once you call us here, we shall be able to tell you what you need to do to get connected so that you can even continue watching this particular video. Otherwise, for now, thank you very much for watching our online videos. Keep on sharing them. And bye-bye for now. Thank you. So that was, of course, for our online followers. For you, don't check out yet. We are with you up to 5 p.m. Very good. So have you been able to pin that question for them there? Not yet. We give you 1 minute. Just a minute, very fast. The students who have access to that question should be able to read the question. Yeah, that question, I can assure you, it was a simple question, but if I was to count, perhaps it's only 10% of the students who did this particular sitting who are able to get that question correctly. May 2015, question number 1, boy. May 2015, question number 1, boy. May 2015, question number 1, boy. Still topic number 1. May 2015, question number 1, boy. 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 Are you able to see? No. And that is why I would really love it if all of us will be able to either print out all the past paper exam questions. It's Chuma Limited. Yes. So you print out all the CASNEP exam questions, file them somewhere. Or you buy our revision kit. You buy this revision kit, 1,000 shillings. And once you buy this revision kit for 1,000 shillings, automatically you'll be able to get access to our 2 live classes for free. Irresistible offer. Irresistible offer. Now, ladies and gentlemen, we are told here Chuma Limited. Are we there? Yes. Chuma Limited, thank you very much. Is considering replacing a machine. The existing machine was bought 3 years ago at a price of 50 million. 3 years ago, price of 50 million. The machine is expected to have a useful life of 5 more years with no scrap value at the end of its useful life. So this machine, ladies and gentlemen, has some 5 more years from today, meaning that The total useful life of the machine is 8 years. Okay. 8 years. The machine could be disposed of immediately at shillings 35 million. At shillings 35 million. Immediately. If you want to sell it today, we'll be able to get 35 million from this machine. We are told the new machine will cost 80 million with a useful life of 5 years and an estimated expected terminal value of shillings 5 million. With the introduction of the new machine, sales are expected to increase by 25 million per annum over the next 5 years. The contribution margin is expected to be 40% and the corporate tax rate is 30%. The operation of the new machine will also require an immediate investment of shillings 8 million in working capital. I love this. Working capital has been introduced. Working capital. Installation cost of the new machine will amount to shillings 6 million. Depreciation is to be provided for on a straight line basis. The company's cost of capital is what here? 12%. Advise the management of Chuma Limited on whether to replace the machine. On whether to replace the machine. On whether to replace the machine. My great students, what do you think of that question? Is that question a nice question that we should do today, or you are comfortable with it, or I can leave it to you to do it as homework? If it is so easy for you, is it an easy question, or it's a question that you think we need to do? Where you compare two machines, old machine, new. If you did your section 3 last semester especially, this is something that you know is quite live over there. We do it, many of them were just a few. Homework 1, we do it. Let's just do it. Take us through it very fast. Okay, thank you very much. So, ladies and gentlemen, remember, for us to be able to advise here, we normally use discounting. We normally use net present value. So, net present value for an asset, you need 3 things. You need, number 1, the things that you need. Number 1, you need the initial outlay. Number 2, you need the terminal. So you're looking at 2 things here. You're looking at initially, how much do I need? When I terminate this project, what am I going to need to get? When I terminate the project, I have the scrap value. And then number 2, ladies and gentlemen, I have the working capital which has to be released. And then in between here, of course, I will need also what are the cash flow. So 3 things: initial outlay, terminal value, and the cash flows for me to get NPV. So we start with the initial outlay. These are 3 marks. Initial outlay. So how much will we need for us, ladies and gentlemen, to be able to put up this new machine on the road? How much? The initial outlay. Very good. The new machine. Remember, it's about new machine. So the initial outlay, number 1, I know the new machine will cost how much. Paragraph number 2, the new machine we are told will cost 80 million. So we have here cost of new machine. This amount is needed initially. Cost of new machine. Cost of new machine. In terms of shillings thousands, the new machine will cost 80,000. So the machine has been shipped. It is here in our factory. We need installation. That installation amount is an initial amount. So installation amount, ladies and gentlemen, they have told us installation amount of the new, ladies and gentlemen, machine. In paragraph number 3, last sentence, installation amount is how much? 6,000. Installation, 6,000. Initially, of course, this machine will not come and operate itself. Initially, I need to inject working capital. So what have they told us about working capital? So in this case, you say there add WC requirements. Add WC requirements. WC means what here? Working capital. Working capital is normally added to the initial outlay, and of course subtract or rather added again to the terminal. So the working capital requirement that this examiner has given us, still on the third paragraph, second last sentence, the operation of the new machine will also require an immediate investment of shillings 8,000. I'm cutting the 3 zeros. So add the working capital requirements. How much here, somebody? 8,000. Working capital requirements of 8,000. Now, ladies and gentlemen, we have some relief. We have some relief. So we have here less relief. Relief in terms of proceeds of the old machine. Proceeds of the old machine. That if we decide to put up the new machine today, we have to sell the old machine. So we have here proceeds, old machine. This is a relief. A relief. So in this case here, proceeds from the old machine. How much is the market value of the old machine today? If I have to sell this old machine today, from paragraph number 1, we are told the machine could be disposed of immediately at shillings 35 million. So 35,000, 35,000. This is a relief. So I need to subtract this from the amount which I need to raise. It's a relief. There is something that all through which makes so many students here get it wrong. Many students will get up to here very correctly. But there is something that so many students here will forget, the concept of what here, taxation. So we have here the tax on disposal of old machine. Tax on disposal of old machine. Very few students even in section 3 are able to remember this. Tax on disposal of old machine. And what do we need, ladies and gentlemen, for us to be able to get this tax on disposal? What we'll do is to take the rate of taxation, which is 30% times the profit on disposal. Profit on disposal. So many people forget this, they end up losing a crucial mark. And remember, for us in AFM, one mark is so important. It can make you see places that you've never seen before. Yes, like now here, there is nobody who has ever seen a door over this park, isn't it? Yeah. So in this case here, we have 30% profit on this. If my cameraman, today I have a very good cameraman, by the way, could swing here, we shall be able to look at the disposals account as a working. Disposals account. The disposals account. Remember, you are disposing which machine? The old machine. So, ladies and gentlemen, remember the first thing that you do whenever you dispose a machine, open a disposals account. And they go to your machine's account and they credit, get the net book value of the old machine. So give me the net book value, give me the net book value of old machine. Give me the net book value of old machine. Kindly help me to get this. Give me the net book value of the old machine as of today. 50M, old machine, net book value. No, 50 million was the original cost. If you look at paragraph number 1, Chuma Limited is considering replacing a machine. The existing machine was bought 3 years ago at a price of 50 million. 31,250. How many of them are able to get that 31,250? Over 10. Ladies and gentlemen, those students are bright. What they have done, for them to have gotten the correct net book value, first of all, they got the accumulated depreciation. First of all, they got the accumulated depreciation. And remember, depreciation, they have told us to make use of straight line. Straight line. So what they've done, ladies and gentlemen, is to get for the old machine the depreciation for 1 year. How do we get this depreciation? Depreciation for 1 year, if you can see here, depreciation for 1 year, depreciation per annum. Don't write on this schedule, right? It will be equal to the original cost is 50,000 minus my scrap value. We were told that this particular machine had a scrap value. At the end of paragraph number 1, sentence 3, the machine is expected to have a useful life of 5 more years with no scrap value. So the scrap value is 0. Come and divide this by the total useful life. So many students were dividing this by 5. We're using the remaining. No, it is the total. Since we bought this thing, we have had 5 years lapsing, or rather 3 years lapsing. And then we have got 5 more years ahead. Please read the first paragraph again. They told us Chuma Limited is considering replacing a machine. The existing machine was bought 3 years ago. It was bought 3 years ago at a price of 50. The machine is expected to have a useful life of 5 more years. So the total useful life is supposed to be 8 years. So could you kindly give me this depreciation per annum? We have 50,000 minus 0 divided by 8. What figure are we able to get somebody there? 6250. But you see, I want total depreciation. I want the accumulated depreciation. So accumulated depreciation, I'll have to come and talk about accumulated depreciation. I will talk about the 6250 times how many years have lapsed? 3 years. Times 3 years. So times 3 years, ladies and gentlemen, 6250 times 3 years gives us what figure? 18,750 is the total value lost. Is the total value lost. Is the total value lost. And if that is the case, then I'll be able to give you the net book value of this old machine, which will be equal to the original cost minus the accumulated depreciation. So NBV here will be the original cost of 50,000 minus 18,750. Minus 18,750. Minus 18,750. Who is able to give me this figure, my great students? 31,250. Now, once you get, in this case here, the net book value of a machine that you want to sell, what you are told is to remove that particular machine from the assets register. And how do we remove it? We shall straight away go to that particular machine's account and credit that machine's account. So we remove, we credit with this net book value from that particular machine's account. And then the same figure will be taken to the disposals account and then you debit. So we have here on the debit side, I will talk over debit this account with the old machine. The old machine at net book value of 31,250. 31,250. Now, once I've debited that account, ladies and gentlemen, I will go ahead and receive money. When I receive money, what happens? I will debit my bank account because the money has gone to the bank. Bank is an asset. I debit the bank account and then credit the disposal account with the cash proceeds. So we go to the disposal account and look for the cash proceeds. The cash proceeds. So if we sell this old machine today, last sentence of paragraph number 1, if we sell the last on the last sentence there, if we sell the machine today, the machine could be disposed of immediately at 35,000. So when I get that money, debit the bank account, credit the disposals account. So we have here bank with what here, somebody? 35,000. From there, what do? You balance your account. Balance your account. When I balance my account, I can see that the debit side is smaller. The debit side is smaller. So what I need to do is to come and I have both sides here balancing at 35,000. Have both sides Balancing at 35,000, meaning that the balancing figure is coming on the credit or debit side here. The balancing figure will be 35,000 minus that 31,250. 35,000 minus 31,250 gives us what? I'm being given a figure of 3750. 3750. 3750. 3750. Remember, the balancing figure is normally taken to the profit and loss account. So here I have debited the disposals account with this 3750. So I'll be crediting my P&L. And any credit entry to the P&L, that is a profit element. So basically, this is a profit on disposal. 3750 is a profit on disposing your machine. So please come back here. Give us 30% of this profit on disposal. Give us 30% of the profit on disposal. So we have 30%. The disposal profit is 3750. 3750. Why am I bringing this argument here? And if you look at the ACCA books, they always have this kind of a question, even exams. Yes, it's because if you have earned a profit out of this interchange, old machine is going, a new machine is coming on board. The assumption will be at this particular point of selling the old machine, the taxman will require you to pay him his fair share of tax immediately. So it has to be part of the negotiations. It has to be part of the considerations which I have to put in when I'm computing the initial outlay. So 30% of 3750 gives me what figure, my great students? 11 what year? 25. I'm being given a figure of 11, 25. And it has to be what year, somebody? A positive figure, because I'm going to pay this money to KRA. I'm going to pay this money to KRA. But remember, if I had made a loss, I would have subtracted. It's like KRA would be reimbursing me. Reimbursing me. But fortunately, it's a profit. A profit is going to be taxed. It's an outlay. We're going to give money to KRA. It's an outlay. So, ladies and gentlemen, that is it. Come and combine everything to give me the total. Give me the total initial outlay. This I have to repeat this again. Not once, not twice, not thrice. Even in block release, I have to repeat this again. Because I know those areas that these examiners normally knock, the sensitive areas where they knock my students.
61, 25.
I'm being given a figure of 61, 25, 60, yeah? 60, 125. So please, if possible, when doing your revision, I know all these other things, you'll be able to get them very well. I would want you to put a star here. A star there. The old machine, when the old machine is disposed, always remember to calculate the tax or loss on disposal. So there we are. We have 60, 125. Yes.
What if the disposal account is a loss?
If the disposal, for example, what if this figure was to be a loss on this side? Meaning straight away that you would have taken 30% of that loss amount, which I would have given you, 30% of this would have given you 1125. But now this time around, it's a negative. It's a negative. It's a negative. You can't say that if you make losses, you don't pay. No, that one does not apply to us in AFM. In AFM. So I know, I've marked these papers for long. I know the areas are disturbed. Like now here, this is a problematic area. So having put a star there for further revision, I would want us to go to the next item. We say number one, we need the initial outlay. Number two, I will need immediately the terminal benefits. That is something that I have to look at. So mention there terminal benefits. Terminal benefits, I'll have to rub this. The terminal benefits. The terminal benefits. So terminal benefits. So terminal benefits. So terminal benefits, ladies and gentlemen, what do I have under terminal benefits? Once you terminate the project, what goodies will come to us? we expect to sell the scrap. So we have scrap value, and please remember that this scrap value has to be the differential scrap value, differential. So we talk of scrap value of new machine. The scrap value of new machine has been provided for in this particular paragraph number 2. They have told us that the new machine will cost shillings 80 with a useful life of 5 years, with a useful life of 5 years, and an expected terminal value of 5 million, of 5 million. So the new machine has a scrap value of 5 million. The new machine has a scrap value of 5 million. Then you will come and you less. Please never forget this also is that when you have two machines you're comparing. Never forget this. Less scrap value of old machine. Less scrap value of old machine. So the old machine scrap value, ladies and gentlemen, we were given scrap value of the old machine. Is there somebody who is able to see the scrap value of the old machine in this question? 0. Paragraph number 1, they have told us. Paragraph number 1, they have told us with no scrap value. Line 2, with no scrap value. So scrap value of the old machine is 0. Ladies and gentlemen, is there any other thing that you think will be important for us to come and add here or subtract? Is there any other thing you think we need really to come and subtract here? Working capital, yes. So we have the working capital. So add here the working capital. Working capital normally is added to the initial outlay and at the same time added to terminal benefits. These are benefits will have to come. So add the working capital of what here? Somebody, how much here? 8,000. 8,000. So could you kindly give us, ladies and gentlemen, this terminal benefit here? The terminal benefit, if you add them, at the end of the day, you'll end up getting what here? 13,000. So 13,000 is my TCS. 13,000 is my terminal cash flow. 13,000 is my terminal cash flow. 13,000 is my terminal cash flow. TCS, terminal cash flow. I'm progressing well. This is the type of questions that you should always get 100% of the marks. So I'll touch on this, go straight away, attack. For example, the money markets. How is working capital a benefit? How is working capital a benefit? Ladies and gentlemen, remember, when we start a project, what happens? You inject working capital into your business, right? And then when your business dies, what happens with working capital? The working capital will be released back to you. Will be released back to you. Working capital, there are no two ways about it. At the beginning of the project, the initial, you are going to put in money in your business. And then at the end of it all, ladies and gentlemen, once this thing dies, the working capital, which you had put in initially, is released. So you'll be given two things. You'll get your scrap value, and then you'll get back your working capital. Working capital. I don't know whether I've been able to answer that question. Incremental? Like which one? Like which one? So if they could put it better, incremental cash flows. In terms of working capital, because you see there is a working which we want to go to. We have looked at the original. We have looked at the initial outlay. And then on the other hand side of the coin, we've been able to look at when the project terminates. When the project terminates. Now we want to look at in between here. We want to look at in between here. Yes. Yes. So then let us now go to the cash flows. So mention there, number 3, the annual cash flows. Annual cash flows. Annual cash flows. So please remember these figures, put them somewhere. So the third component are the cash flows in between. So the annual cash flows. Annual cash flows, yes. Oh, Mary anawaambia relax. Relax, relax. Pata bottle moja ya Coca-Cola. Relax, hajafika hapo. Very good. Now, ladies and gentlemen, let us look for this information on what here somebody. This information on cash flows now. Look at paragraph number 2. Paragraph number 2. Paragraph number 2, ladies and gentlemen, they have told us the new machine will cost 80 million with a useful life of 5 years and an expected terminal value of 5 million. With the introduction of the new machine, sales are expected to increase by 25 million per annum over the next 5 years. 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 If you continue reading this, they have told us the contribution margin is expected to be 40% and the corporate tax rate is 30%. So they have given us the tax rate. The corporation tax rate has been provided. And in the normal class, we say, whenever corporation tax rate is given, always compute depreciation. Whenever tax rate is given, always compute depreciation. So I would want somebody, as our first working for these annuity cash flows, I would want somebody to compute for me the depreciation of the new machine. Depreciation of the new machine. So come and give me depreciation of the new machine. Depreciation of the new machine. So remember, we are using straight line method. Straight line method, it's initial cost minus scrap value divided by n. So depreciation of the new machine, what do we have? Do we know the initial cost? Initial cost, ladies and gentlemen, depreciation for the new machine. We are told in paragraph 2, the initial cost is 80 million, so 80,000 minus the scrap value of the new machine, which in this case here we have been told is 5 what? Is it 5 million? The new machine will cost 80 million. There is something here we would have forgotten very fast. Installation cost must always be capitalized. Installation cost must always be capitalized. So the total initial cost of the new machine is supposed to be what here, somebody? 86,000. 86,000 minus, ladies and gentlemen, the terminal value, the scrap value. Who can give me the scrap value of this particular machine? The scrap value. 5,000 years. Because they have told us on that particular paragraph 2, in paragraph 2, the new machine will cost 80 million with a useful life of 5 years and an expected terminal value of 5 million, but now in terms of thousands, this will be 5,000. Thank you very much. Divided by how many years? Somebody talked to us this afternoon. Divided by how many years? Number of years are 5. So please give us the figure. So somebody give us the figure. What do we have over here? This will be 86,000 minus 5,000 equals divided by 5, which at the end of the day will give me 16 what here? 16,200. I'm being given a figure of 16,200. 16,200. 16,200. 16,200. From there, come and compare this with the depreciation of the old machine. Depreciation of the old machine. Whenever corporation tax is given, depreciation is normally relevant. And you guys, if I'm not wrong, you were able to give me the depreciation of the old machine per year as what here, somebody 62 what? 50. These are working that we have somewhere per year. Per year. So come and subtract the two to give us the incremental, the increase in depreciation. The increase in depreciation. The increase in depreciation. So the increase in depreciation here will be 16,200 minus 6250, which gives me 9950. Which gives me 99 what here? 50. Which gives me 9950. Now, if that is true, now we can start looking at our income statement. So mention there, income statement. Income statement. The income statement, very easy. So the income statement, ladies and gentlemen, that I have here, I will start with the sales. The increase in sales. So sales increase. Sales increase. Everything is about increase. If we bring a new machine, we expect to increase. So the sales increase, ladies and gentlemen, what do we have here for the sales increase? Look at paragraph number 2. Paragraph number 2, sentence number 2. With the introduction of the new machine, sales are supposed to increase by 25,000. 25,000. So please look for expenses, we subtract. Look for expenses, we subtract. Actually, here there is nothing even to subtract. They have given us the contribution margin. So given the contribution margin, then I should be able to get what we call total contribution. We should be able to get the total contribution. So total contribution, what will I do? I'll come and double underline this. Is not important to me. I'll double underline it, meaning that is the final of that figure. Total contribution, we have been told the margin. The contribution margin is 40%. So it will be 40% of the sales increase. 40% of 25,000 will end up giving me what figure? Somebody, we have 0.4 times 25,000, which will end up giving us, ladies and gentlemen, 10,000 shillings. 10,000 shillings. Once I get my contributions, what am I supposed to do? I'm supposed to scan through the question to see whether we have got any relevant fixed costs. So they come and say here, less fixed costs. So when I look around that question very well, I'm not able to see, not unless I'm blind, I'm not able to see, ladies and gentlemen, any note on fixed cost. So just for revision, it's important you just put it there and then you say 0. You say 0 like that. So 10,000 minus 0, 10,000 minus 0 gives me 10,000 there. So this 10,000 figure that I have is my profit. But now, which type of profit is this? Which type of profit? Remember, to get profit, we normally take total contributions minus fixed costs. So I've been able to subtract to get here my profit. This is the first profit that you get in finance. The very first profit you get in finance, ladies and gentlemen, should be profit before depreciation and tax. So you come and call this one profit before depreciation and the taxation, like that. Because you haven't yet charged depreciation here. So it's profit before depreciation and tax. There are two ways about this. Some students will always prefer the situation where they go ahead and tax this figure and then they add the shield. They add the shield. But personally, I prefer the longer way. The longer way is the one where you come and subtract tax. So you say less tax, less tax. So what is the rate of tax given? Is 30%. Less tax at 30%. So can somebody give me 30% of 10,000? 30% of 10,000. 30% of 10,000. This gives me what here? Somebody 3,000. Subtract like that. So 10,000 minus 3,000. This will give me 7,000 shillings. So this is what we call the profit after what here? Tax. Once we get the profit after tax, it's not lost on us. What is supposed to be done? Once I get profit after tax, what I need to do is to come and add back depreciation. You add back all the non-monetary items, of which in finance, mostly the non-monetary item is depreciation. So you tell us there, add back depreciation. Add back depreciation. You add back depreciation. So add back which depreciation? The one that you got here, the incremental. You add back depreciation. You add back depreciation. So add back depreciation. Depreciation over how much? 99.50. Depreciation of 99.50. So 7,000 plus 99.50 will end up giving me what figure? Will end up giving me what figure? 7,000 plus 99.50 will end up giving us what figure, my good students here? There is a problem here. There's a problem. We never subtracted depreciation. How could I tax without, I'm so sorry. How could we tax without subtracting depreciation? There's a problem. Sorry for that. There's a problem here. If you're using the longer method, this one here would have been great if you wanted to use the shorter method. After getting this, I need to come and less the outcomes nobody solves this. I need to come and less depreciation first. How do I add back what I never subtracted? So less depreciation over how much here first? 99.50. Please forgive me for that. 99.50. So could you kindly come and subtract this and give us a figure to write here? So 10,000 minus 99.50, what are we able to get somebody there? Sorry for that, just rub as you cast me a little bit. Don't cast me too much, you. Don't cast me too much. 10,000 minus 99.50 gives us what figure? 50 bob. So these 50 shillings is what we call the profit before tax. 50 shillings is what we call the profit before taxation. This is the profit before taxation. Profit before taxation. So in my continuation here, I have my profit before tax of 50, which I'll come and say less taxation at 30%. So 30% of 50, you're going to give the taxman something very small. 30% of this 50 gives me what figure, somebody? That gives me what figure, somebody here? 15. So come and subtract. What are you able to get? 35. This is what we call the profit after what year? After taxation. Once I get my profit after taxation, I need to come and add back very first the depreciation again. So you say add back, depreciation of 99.50. Depreciation of 99.50. So once you add like that, what are we going to get at the end of the day as our cash flow per annum? So give us our cash flow per annum. Our cash flow per annum. So you add the two, you get 99? 85, thank you very much. 89, 85, thank you very much. Now this cash flow, I would want someone to talk to me this afternoon. Is it an annuity or an irregular cash flow? Somebody talk to me this afternoon. Is it an annuity or an irregular cash flow? It's an annuity. How have we known that this is an annuity? It's because of, look at the sales they gave us. The sales in this case here that they gave us, they told us in paragraph number 2, sales are expected to increase by that 25 million per annum over the next 5 years. So in that case here, then the relevant sales will be that 25 million every year. That is the relevant sale. So once they give us metrics which are on a per year basis, just like our depreciation was for 1 year, then automatically the figure that we have here will be an annual figure. It's an annuity figure. So it's an annuity that we shall enjoy for how many years? How many years are we going to enjoy this annuity? 5 years. 5 years. So I want you to do for me 2 things. Number 1, you give me the PV FAR. The PV FAR. You give me the PV FAR, 12%, 5 years, and then you give me PV, 12%, 5 years. Give me those two things. Those are two marks for free. We're normally very liberal whenever it comes to marking of this paper. Very liberal. You can't really get great people like ourselves. We are the best. So PV for 5. So first of all, I will start with PV. PV for 5 years. PV is the easier formula. PV is the easier formula. So PV, to get PV, the easier formula, you and I know that PV is 1 plus R raised to negative n. That is the PV formula. Ladies and gentlemen, for us to get the PV, we have the cost of capital, which the examiner has given us. The cost of capital is 12%. The cost of capital is 12% raised to negative n. And the n here is what here is 5. So then we are talking of 1.12 raised to negative 5. How many decimal places? 4. 4 decimal places. So we have here 1.12 raised to negative 5. What shall we get at the end of the day? What shall we get at the end of the day? Somebody, please. 0.12 raised to minus 5. Who is able to give us a figure? Somebody here. 0.56674. Is it only one student or many of them? Several. Thank you very much. Now, how about PV? How about PV? How do we get PV? PV, ladies and gentlemen, I will take 1 minus the easier formula divided by R. So for PV, the formula is very well given. For PV, the formula, I want to remind you this for the umpteenth time, that PV is 1 minus the formula that we have here, 1 plus R raised to negative n, and then everything will be divided by what there? By R. So then what do we have here in this? It will be 1 minus 1.12 raised to minus 5, and then everything to be divided by 0.12. So could you kindly give me the answer? I'm being given a figure of 3.6048. I hope it's everybody who is able to get this figure. Now, ladies and gentlemen, listen and listen to me very well. What I will do, I will now come and compute the net present value. So how do we compute the net present value? To compute the net present value, I'll first of all look at my cash flows, my benefits. The first benefit being the annuity benefit. So I'll come and take this annuity benefit, and because it is an annuity, I have to multiply it with the PV. So this one has to be multiplied with the PV. This one will have to be multiplied with the PV. And then from there, you come and take, never forget the TC, the terminal cash flow. By the way, what did we get for our terminal as our terminal cash flow? What is our terminal cash flow? Our terminal cash flow was 13,000. 13,000. But now remember, this is our one-off figure, which will be coming to us all the way from the end of year 5. Only one-off figure. So it can only be multiplied with PV. This can only be multiplied with PV minus IO minus the initial what year? Outlay. Minus the initial outlay. Minus the initial outlay. Minus the initial outlay. So if that is the case, then ladies and gentlemen, fortunately we have these discounting factors. What we need to do is to come and replace them. So we have 985 times PV for figure is given somewhere here, which is 3.6048 plus 13,000 times PV for PV is given here, which is 0.5674 minus IO stands for the initial outlay that fortunately we were able to get. The initial outlay that we got ourselves here as 60,125. 60,125. So could you kindly, in this case, ladies and gentlemen, give us the answer? for this?
Is a figure of negative 16.
There's a figure of negative 16.
754.
Many students?
No, only Edith.
Only Edith.
Bianca. Yeah. Josephine. Almost 6 of them.
The same answer. Negative what here, somebody?
16.
Negative 16?
754.
754. Thank you very much. Negative 16, 754. Whenever we get a negative net present value, is that really a good thing? A negative net present value means that the project is not viable. So in this case here, refuse. Do not accept the new project. Continue with the old what here? Project. Continue with the old project. Continue with the old project. Now, I would want you guys to do me a favor. I know the sensitivity of these things here. I would want you to assume that you have known nothing. And even the nothing that you have known it wrongly. And go tonight, or tomorrow latest. I want to give you any homework. You go and repeat this. You put the solution aside. You repeat this question yourself slowly, step by step. And then when I come on Tuesday during block release, I also need to start with this, of course, using a bigger ACCA question. ACCA question. So if you are in agreement, allow me to go to the third question, still on replacement. Still on replacement. And I would want my friend here to put up the ACCA F9 question number 39 on the screen. It's the question that I sent you through WhatsApp. Still a replacement question. And if you want also to get a present for this particular paper, ensure that you have got this booklet of ACCA. The ACCA F9 booklet is a booklet that you must have, which I should be able to ensure that each one of us gets today. And then, of course, you practice using it. For both AMA, you need the ACCA equivalent, and AFM, you need that F9 paper. F9 paper. So once you do their questions, these examiners will always keep on doing what they are, borrowing questions from ACCA. I've never seen a single question that does not have some background from ACCA. All these questions, including this one that we've just done, we even have a solution of the same in the ACCA booklet. Question number 39. Have you been able to get it? Question number 39. Replacement. Just increase the font size. Yes. Calvic Company Limited, question number 39, where we are required, using the equivalent annual cost method, calculate whether Calvic Company should replace its fleet after 1 year, 2 years, or 3 years. So they're telling us, ladies and gentlemen, that Calvic Company services custom cars, and it provides its clients with a courtesy car while servicing is taking place. It has a fleet of 10 courtesy cars, which it plans to replace in the near future. Each new courtesy car will cost $15,000. The trade-in value of each new car declines over time as follows. They were given as age of courtesy cars 1, 2, 3, meaning that I'll have to do a replacement cycle for 1 year, replacement cycle for 2 years, replacement cycle for 3 years. And then I can see the trading values being given there. Servicing and the parts will cost $1,000 per courtesy car in the first year, and this cost is expected to increase by 40% per year as each vehicle grows older. Cleaning the interior and exterior of each courtesy car to keep it up to the standard required by Calvic's clients will cost $500 per car in the first year, and the cost is expected to increase by 25% per year. So they're telling us there, Calvic company has a cost of capital of 10%, and then the examiner is good examiner, ignore taxation. So using the equivalent annual cost method, calculate whether Calvic company should replace its fleet after 1 year, 2 years, or 3 years, ladies and gentlemen. So the vote. So ladies and gentlemen, this is a straightforward question. And what I'm going to do is just to consider cash flows of one car over each of those 3 years cycles. One car only. So we start with 1 year cycle. We have again 2 year cycle. So 1 year cycle, what do I have? 0, 1, 1. Now you can see here they're not talking of replacing an old machine with a new one. This is just our cycles replacement. One car. So I want the cash flows. So the cash flows, what we have here at time 0, how much will this car cost us at time 0? How much will this car cost us at time 0? They're not talking to me. They're not talking to me. Oh, they don't have that question. Actually, I should have even given them some time to write it down. Yeah, please take like 2 minutes. Take like 2 minutes and try to pull that question down. Take like 2 minutes, try to pull that question down very fast. Just copy it. There is power in writing. When you write, you understand better. Please share screen. What is your share? Okay. So now I hope you have gotten some time to write it down and even to understand it much better. So let's now do the question together. So I'm happy because I've also gotten some good feedback from you. At time 0, ladies and gentlemen, time 0, we expect to buy the car, 15,000. And then now we go to year 1. So year 1, what have they told us? Year 1. Are there expenses which are to be incurred in year 1? Are there expenses which are going to be incurred in year one? 1,500 for what? Please read the question again. Servicing parts will cost 1,000 per courtesy car in the first year, and this cost is expected to decrease. So we have in year one, we have servicing. Servicing will be 1,000, so negative. And then again, we have another cost of cleaning of 500. So both of them are cash outflows coming to us at the end of year one. So ladies and gentlemen, this gives me, right, minus 1,500. So now come to end of year, or rather, again, end of year one, there is something that is going to happen. This second one normally takes care of what here? The resale value. When I sell it like this, I should be able to get, in this case here, some value that will realize some kind of scrap value. And you will be able to see where they have given us, ladies and gentlemen, this question. We send the question on WhatsApp because Bianca can't see the screen. So I don't know whether Bianca is in AFM1 or AFM2. So I just need to share it in both very fast. We just need to share these very fast. So we have there. I know even other students have it. If you have it quite close there, you simply share that question, simply share it. So I've been able to share it to AFM-A, AFM-B, and AFM-C. AFM-C. Okay. Thank you very much. So at the end of year one, we are discussing with this end of year one, ladies and gentlemen, we are good because this is a 1 year cycle. We're going to sell this thing at the end of year one. And if we sell it, what benefit will it give us at the end of year one? At the end of year one, what benefit will we get? They have given us the trade-in value. They are going to value this vehicle. At the end of year one, I can see like a resale value of 11,250, like that. So come and create a column here for PV. At what percentage? 10%. At 10%. PV at 10%, at 10%, at 10%. I hope my cameraman is able to see me right away up there. At 10%. So 10% is quite easy to get the PVs. So we have here the first one is 1. This second one will be 0.9091, which will apply here because of year one, 1991. So come and create a column of PV, present value, and do multiplications for us. Present value, and then you do multiplications for us. The first one, ladies and gentlemen, will end up giving us minus 15,000. Minus 15,000. The second one will be, we have here minus 1,500. Minus 1,500 times 0.9091, which gives me minus 13. Minus 13, 63.65. And then the last one, which is positive, is 11,250 times 0.9091 times 0.9091, which gives us 10,227. So I'm interested in 0.38. I'm interested in the net present value. Once you add everything there, you should be able to get the net present value, which would be minus 15,000 minus 13, 63.65 plus 10,227.38, which will end up giving us minus 61, 36.27. If I'm correct, that is the figure that I should be getting. Go to 2 year cycle. 2 year cycle, we are writing here 0, 1, 2, 2 is the end of the board. So 0, 1, 2, 2. So I expect you, great students of mine, to give me the figures of cash flows. Give me the figures of cash flows. They are very fast. I'm giving you a minute. I'm giving you a minute. So, ladies and gentlemen, let's look at year number 2 together. Let's look at year number 2 together. Year number 2 together. So, for year number 2, we have this servicing cost, which was 1,000 in year 1. In the second year, it is going to increase by 40%. So, I will have here my 15,000 will still remain, right? But now, end of the year 1, fine, I still have minus 1,000, minus 500. But now when I go to year 2 onwards, they have given us a crutch word that from year 2, we expect the servicing cost to go up by 40%. So this will be minus 1,000 times 1.4 minus 500. This 500 is also going up by what percentage? 25%. So times 1.25, give us a figure there. So then this one here will be minus 1,500. How about the second one? The second one, we are told here will be minus 1,000 times 1.4 minus 500 times 1.25, which will end up giving us minus 20 points, or rather minus 20.25, minus 20.25. Now, ladies and gentlemen, the moment I have that, remember this second year basically is that year of bending, is that year of selling the asset, of which they have told you if you sell this thing today, you'll be able to get this trade-in value. And then, of course, you add that some amount to get a new vehicle. The trade-in value for year 2, which they have given us, ladies and gentlemen, the trade-in value there for year 2 is 9,000. It's 9,000. So straight away, come here and provide a column for PVIF. Provide a column for PVIF. Our PVIF, ladies and gentlemen, here. Our PVIF, ladies and gentlemen, here at 10%. The first one is 1. The second one is 0.9091. Then we have 0.8464. 0.8. Please confirm this figure. End of year 2. What is the PVIF of end of year 2? 1 plus 10% is 1.1. Raised to minus 2. Raised to minus 2. What figure are we able to get? 8264, eh? 8264. And then, of course, we are talking of year 2 again. This will be 0.8264. So come and create the last column where you're going to get the present value. We shall get the present value. So the present value will be this times that, give us a figure. This times that, give us a figure. And then at the end of the day, come and add to give us the total net present value. Add to give us the total net present value. The total net present value, which will be equal to what, ladies and gentlemen? Negative 10 point or just.
So it is 10,599.
10,000.
599.5. But it is in brackets negative.
Negative, eh? Hey, how comes that big? That's so big. That's so big.
Negative 10,599.
599 points.
10,599. 10,599.
10,599, but what a negative, isn't it?
Yes.
Like that. So now your homework, ladies and gentlemen, I would want you to go and finish the 3-year cycle, and then you give me the annuity equivalent values. You give me the annuity equivalent values, and then I'll be able to share with you this book for purposes of doing what here? For purposes of comparing figures. And then if possible, I would want each one of us to do this question of sensitivity analysis of last semester. Sensitivity analysis of last semester, which I'll be able to share the solution with you immediately after this class. Otherwise, I want to imagine that you've gotten some value. I don't want to proceed because of the Muslim prayers. It's normally come around this time, right? And of course, now see you right on Tuesday. During our block release, I'll be able to share our first model papers with you by tomorrow. Thank you very much. Bye-bye.